Many do-it-yourself investors are being drawn to the benefits of selling covered calls on stock that they already own. One huge benefit is that of receiving immediate cash into your brokerage account when you do sell your calls. Should you be selling calls on a monthly basis, this can turn out to be a significant stream of cash flowing into your account. Not only do you benefit from the monthly injection of capital, but you also reduce your risk of loss of capital. The cash being deposited into your brokerage account when you sell your calls decreases the cost of your initial stock purchase. This means that the stock price would have to drop below this new cost basis for your stock in order for you to be in a losing position. You have effectively built in some downside protection for a price decline in your holding. When you sell covered calls on dividend-paying stocks that pay you a quarterly dividend, not only do you benefit from the above-mentioned advantages, but you can also layer on cash flow strategies so that your overall potential returns increase. The biggest challenge that faces many a do-it-yourself investor is figuring out how to collect both the call option premium and the dividend without having the stock being sold inadvertently. This scenario could present itself should the stock price rise above the call option strike price, placing the holding in a position of being called away, or in other words, sold. So how does one account for this specific challenge? Let me walk you through a simplified case study of how you could address this particular scenario. In this case study, we'll take a look at the insurance provider Aflac, symbol AFL. Many of us are familiar with the amusing Aflac Duck commercials on TV. Aflac offers supplemental health and life insurance in the two largest insurance markets, the US and Japan. For this case study, I'll walk you through a simple mental framework called the FAST approach to help you with your decision-making process. The acronym FAST stands for Finding Wonderful Businesses, Assessing Their Growth Potential, Strategizing the best ways to optimize one's ability to generate consistent cash flow, and determining the appropriate timing for entering and exiting positions. The first order of business is in finding an appropriate dividend-paying candidate. I did my initial screening for finding a potential business to assess by using Charles Carlson's Big Safe Dividend formula from his website. His formula focuses on identifying fundamentally sound dividend-paying companies who have low payout ratios. The lower the payout ratio, the more capital that is kept in the company to be used to hopefully grow the business and offset any unexpected financial crises. Low payout ratio dividend-paying stocks offer greater long-term stability for the investor. His formula rewards businesses that have payout ratios below 60%. At the time of the analysis, Aflac had a BSD, or Big Safe Dividend score, in the top 10%. The stock was trading at just above $50 with a current yield of just over 2.6%. After selecting this potential candidate, it was time for me to assess the company's growth potential. For doing a quick assessment of the fundamentals of this particular stock, I used the free stock analysis data on Morningstar's website. In checking out some of the key ratios on the home page and key ratios page, I found that revenue, earnings per share, and return on invested capital growth rates all averaged just over 10% over the past 3 years. I look for consistent growth rates, preferably over 10%, over a minimum 3-year period of time. These key ratios and the book value per share growth rate, as well as the cash flow growth rate, are my favorite indicators to use in assessing the financial health of a company. I also noted that the debt-to-equity ratio was quite low, being less than 0.4, which is a good sign of a company that is better able to weather a correction in the stock market. After this initial assessment, I determined that this company was one that I would put on my watch list as a possible investment opportunity. My third step was to strategize how I could tap into a combination of quarterly dividend payments and monthly call options. This step is the S in the FAST approach. The first option strategy that came to mind was in using out-of-the-money call options periodically throughout the year to capture both the option premium and some upside stock appreciation. Selling out-of-the-money calls does not produce rich upfront premiums like an at-the-money call. However, it does afford some protection from the stock being called away, that is, sold prematurely. The stock price would have to appreciate up to the out-of-the-money strike price before being in jeopardy of being sold. This could be an acceptable level of risk to consider when periodically selling calls on dividend-paying stocks. So to recap, my initial thoughts were to occasionally sell out-of-the-money calls when the timing appeared to be appropriate. Which brings us to the last letter of the FAST approach, T, which stands for timing. Continuing with my analysis, my first step was to look at the past year's quarterly dividend payments in contrast to when the company announced its quarterly or annual earnings. Aflac's fiscal year end is December 31st, and the company posts its annual report near the end of February each year. The ex-dividend date, the date that entitles you to receive the dividend payment, occurs mid-month in February, May, August, and November, with the quarterly earnings reports happening at the beginning of these months. I could count on having dividend payments being made 4 times per year in what appeared to be a financially solid company. Now I needed to factor in some timing tips to keep me out of trouble. Knowing that earnings announcements can have a significant impact on the price movement of a stock, I needed to be aware of those call option months affected by these periods of time. In most cases, you're better off sitting on the sidelines when earnings are announced before committing to any option position. Since the quarterly reports come out at the beginning of the month, those option months that could be problematic start just prior to the earnings announcements. In other words, the option cycles for April, July, and October overlap the announcement dates. You may wish to adjust your timing for selling call options for these months, holding off any commitments until after the big boys have done their volatility dance around earnings announcements. Recall that option contracts expire the 3rd Friday of each month. Another point to keep in mind is that not every month of the year has an option cycle. Aflac releases its annual report at the end of February, usually after the option cycle expiration. This is a less problematic situation to be in. However, keep an eye out for rumors during the last week of the cycle prior to expiration Friday for possible increased price volatility. It may be prudent to close out your position to avoid any unexpected surprises. To help you gain a broader perspective of how the stock is trading throughout the year in relation to other stocks, get into the habit of periodically looking at 3 technical charts. For a broad overview of the economy, I like to look at the S&P 500 index over a 5 to 6 month period of time. I also like to use a 50-day and 200-day simple moving average to get a better perspective as to how the market has been moving. Along with the moving day averages, I'll look for patterns in the volume of shares being traded. Slowly rising volume over a period of time can signal growing confidence in the stock market. After a quick look at a broad index, I like to drill down deeper by looking at a technical chart of the economic sector that the company belongs to. In the case of Aflac, it belongs to the financial sector. At this point, I'll look at a technical chart of the financial sector by using the SPDR or SPDR for the financial sector, which has the symbol XLF. I try to get a feeling as to how the money is flowing into the sector versus the market as a whole. Sectors move in and out of favor with Mr. Market depending on product or service demand cycles through the course of a normal business year. If I notice that money is flowing out of the sector in comparison to the market as a whole, I may reevaluate my investment strategy so as to further reduce my exposure or potential risk of capital loss. If I notice that the sector has moving day averages that are slowly rising, I take that as further support for my initial investment strategy thesis. My original premise of periodically selling out-of-the-money calls is now gaining further support. Finally, after getting a flair for what the market is doing, I take a look at a technical chart of the specific stock in question. In our case, this would be a chart for Aflac showing 3 to 4 months of data points and using a 20 and 100-day exponential moving day average as one set of indicators. the exponential moving day average places greater weight on the most recent price changes. Using a 20-day average corresponds well with the typical 1-month option cycle that most covered call sellers like to use. And the 100-day average gives you enough data points over several months for comparison. As you can see from the technical chart, there has been a slight increase in the volume of shares being traded in the last few weeks. Slowly rising stock prices on rising volume is a vote of confidence in the business by the market players. Just another confirmation factor to help us with our decision-making process. I also like to use two other indicators, the RSI, Relative Strength Index, and the MACD, or Moving Average Convergence Divergence. The Relative Strength Index can be used to monitor oversold or overbought conditions for a particular stock. Extreme high or low signals can indicate potential danger for an investor, as money flow could change course, driving prices lower or higher. A relative strength index between 50 and 80 often helps to confirm investor support for that particular equity and gives me yet another green light to further confirm my initial out-of-the-money call strategy. The other indicator that I like to use is the MACD, which is a trend-following momentum indicator that may help you determine when a trend has begun or ended and may reverse direction. I prefer using a bar graph representation of the MACD. What I'm most interested in is movement above or below the zero line as the bar chart creates hills and troughs. The whole process of checking out the technical charts takes me less than 10 minutes to complete. A great service to consider using is found at stockcharts.com, where you can use either free or paid services for your technical analysis needs. So let's do a quick recap of what has transpired so far in using the FAST approach. Recall that I initially found Aflac as a potential candidate in using Charles Carlson's site Big Safe Dividends. I then did a quick assessment of the fundamentals by using Morningstar stock analysis website. The next step was to strategize how I could potentially optimize my cash flow by periodically using out-of-the-money covered calls. And then we explored some timing considerations and pitfalls to avoid. The timing consideration was to avoid committing to a call option position when an earnings report could jeopardize having your stock sold prematurely. The next step was getting a technical read on the market, sector, and stock to confirm whether or not our original out-of-the-money option strategy had a high probability of success given the technical data analyzed. From start to finish, this initial assessment took less than 30 minutes to complete. Now the choice is up to you as to whether or not you would like to drill down deeper into the analysis or move to the next step of logging into your brokerage account and checking out several potential option returns that might meet your needs. As you can see from using the FAST approach, we have a step-by-step action plan that moves us in the right direction of determining whether or not to sell covered calls on a dividend-paying stock at a particular time of the year. I hope that this quick case study points out the enormous cash flow generation potential you have by using a combination of dividend stocks and periodically layering on covered call positions. Should you like to learn more about becoming a better do-it-yourself investor, then please check out the video tutorial series, The FAST Approach at Stock Investing Simplified.